Welcome, learners. Welcome back to our segment today. I'm your instructor, CPA Ringo Frederick. Remember, in our today's session is just a continuation of our series of classes of advanced financial management. And the concept that we are looking at the capital structure theories. Of course, the capital structure theories, the last class that we did was for Modigliani and Miller, where we looked at preposition number 4. If I was to take you back on what you are doing, my good students, just before we look at our concept of today, remember we started by mentioning, or whenever we were looking at Modigliani and Miller prepositions, right? Looking at Modigliani and Miller prepositions, which we termed it as MM prepositions, we talked of 4 prepositions, yeah? We talked of 4 prepositions, where we talked of Modigliani and Miller preposition number 1. In this case, you are looking at, we don't have corporation taxes, no taxes at all, yeah? No taxes. Where preposition number 2, they improved it, and in this case, there was inclusion of taxes. So in this case, you're looking at corporation taxes, Modigliani and Miller preposition number 2, corporation taxes. MM preposition 3. In this case, this was improved further, and because it is the investors who are receiving, of course, these dividends from the company, then they're also going to pay their personal taxes, yeah? So that's why at this point we talked of both corporation and personal taxes. Corporation and personal taxes. That is what we covered in MM preposition number 3. Remember what Molimu is doing? Molimu is just reminding us on what we had looked at earlier on in our classes. Then finally, our last class, we talked about MM preposition number 4, which is also very interesting. MM preposition 4. Yeah, MM preposition number 4. MM preposition 4. On this, we talked of corporation taxes, or rather, the environment of taxes, and financial distress costs. Financial distress costs. Yeah? Where, in this case, Molimu explained it clearly to us. Molimu explained it clearly to us here under this preposition number 4, that the main types of costs that we are terming them as distress, of course, we'll be having the urgency and the component of bankruptcy costs. I'm just taking you back on what we did so that when I relay the concept of what I want us to handle today, things will be very easy because they do relate with what we handled earlier on. So my good students, these are what we talked about in our previous class. In our today's session, we are looking at a very interesting concept here, Hamada Model. We are looking at Hamada Model. And now one will ask Molimu, what is this Hamada model that you're talking about? That's what I want us to discuss. That is what Molimu will want to discuss in our class today, the concept of Hamada model. So, explaining Hamada model, my good students, I'm going to relate with what we did earlier on. And that's why it's coming immediately after what we did. Yeah? So, at this point, if at all, I can take you back, yeah, to what we mentioned on Modigliani concept when we were introducing it. At this point, remember, at some point, Modigliani and Miller, they were with a mind that in the environment of no taxes, you'll find that at this point, the component of debt in our structure will be irrelevant. The component of debt in our structure will be irrelevant in a way, yeah, because I won't be having that component of course, the aspect of savings in relation to the interest that we'll be paying, yeah. So you'll find that on this case, as much as there are so many improvements, Hamada came up with this model. Of course, the non-financial term, if at all you can term it, analyst, right? Robert Hamada, where in this case, we will be combining the concept of Modigliani and Miller concept with what we did some times back, the concept of, if at all you can remember, CAPM. If at all you can remember, CAPM. So, what is this Hamada model, my good students? You'll find that it is an interesting, a very, very interesting concept, because other than just looking at the effect of the taxes, we must incorporate it with what we did earlier on in relation to the capital asset pricing model. So at this point, you'll find that Hamada model combines, yeah, very important to know that Hamada model combines Modigliani and Miller theorem and the concept of what we did some times back, CAPM. Do you remember CAPM? So it combines the Modigliani and Miller theorem on capital structure, yeah, Modigliani and Miller model on capital structure, on the capital structure, and what? On capital structure with the CAPM, with assets, with CAPM, with capital asset pricing, with capital asset pricing, yeah, model, which we talked of CAPM. To bracket, we are talking of CAPM. So Hamada model will combine both the concept of MM in our capital structure with the asset pricing, capital asset pricing model, CAPM. So the question is, do you guys still remember what we did with CAPM? Yeah, do you still remember what we did with CAPM? Because at this point you'll find that once we have this, the whole effect is that you just want to look and understand the relationship between the financial leverage. At this point, the whole idea, we just want to understand the relationship between our financial leverage. Yeah, we want to understand the relationship between our financial leverage, yeah, and risk and cost of equity. What is the relationship between all these? Financial leverage, risk, and cost of equity. Because recall again that we said anytime or when you're analyzing the concept of capital asset pricing model, the whole idea was all about aspect of risks. Yeah. And it is on the same class of CAPM that we realized that we'll be talking of two forms of risks. Do you remember this risk, my good students? Do you remember the risk that we talked about? We talked of these two types of risk, which includes the unsystematic risk. And number two, we also talked of what? Systematic risk. Where unsystematic, the whole idea here, we're looking at the CML, capital market line. Yeah. Whereas when you are talking of systematic risk, you're talking about what? CAPM. Systematic risk is a form of risk whereby the whole market is affected. And if the whole market is affected, now we are not looking at specific return, but rather we are looking at the whole market. So at that point, the concept of beta, you should recall that, right? The concept of beta, we talked of that, right? So we're saying that Hamada model, what you're trying to do here is to identify the relationship between our financial leverage, risk, and cost of equity. And at this point, you're saying that when you are talking of risk, I've taken you back to recall. Recall the unsystematic and systematic risk. Our focus will be on the systematic risk. And I still have that belief that you still do remember how we were looking at these risks. Yeah? Remember this concept? We did all this. Yeah? We did all this with you, my good students. Where if at all you're asked to explain the concept of risk diagrammatically, what must you be able to recall or have in mind? Then it is important for us to recall this is what we did. Yeah? Where we were looking at this being systematic risk and the top being unsystematic risk, because the systematic risk cannot be reduced by holding any form of portfolio. So this is a unsystematic, where this risk can be reduced by holding a portfolio, whereas systematic risk, regardless of our portfolio that you're having, is not going to be reduced. And clearly we did this. Yeah, I'm just reminding you on what we did. So back to what we are doing now, you'll find that therefore at this point it is important to, of course, have this concept by realizing that the Modigliani and Miller, yeah, the assumption was in the ideal world without taxes, the bankruptcy costs or systematic information, a company's value was unaffected. The company's value was unaffected. But with real reality, you'll find that taxes do exist. Yeah? Taxes do exist in our real world. And therefore, the market value of our company will be affected in a way. That is Modigliani and Miller. What about CAPM? This is what Mwalimu was trying to jog our mind to recall what you did with CAPM. So you'll find that CAPM states that the expected return on equity or the cost of equity is equal to the risk-free rate plus the equity beta, where I'll just take you back. Yeah, today Mwalimu is reminding us a lot of what we did basically back then, yeah, when we are looking at the concept of portfolio. So remember, for CAPM equation, we said that I'll be talking of, if at all you can recall the CAPM, yeah. In relation to CAPM, this is what we said. For us to determine the risk, I'll be having our risk-free, right? Then this will be affected by what we're referring to as the component of risk premium. And how were we achieving our risk premium? For us to achieve our risk premium, we are talking of the expected return on the market, minus our risk-free. What we were incorporating, my good students, if you can recall, we were talking of the beta, right? We are talking of the beta of the security, because beta of the market will always assume to be 1. So we are talking of beta of the security. This is clearly what we did under CAPM. So Mwalimu, or one will ask Mwalimu now, what is the relationship between all this? Because you told us, you talked of Modigliani and Miller, and now you're also talking of the concept of CAPM. What is the relationship then? Because you say that Hamada model combines MM theorem. MM theorem is all about determining the valuation of a company, and we looked at various concepts of Modigliani and Miller, and we are saying, looking at it, combines MM theorem on the capital structure with capital asset pricing model. So this is the capital asset pricing model. So I've taken you back to the both concepts, so that when we will be talking of now Hamada, things will be very easy for us to understand. So therefore, you'll find that Hamada's equation specifically addresses how the equity beta is affected by the use of debt. Now, this is where the relationship is coming. So you'll find that Hamada, yeah, the Hamada equation specifically, yeah, I'm going to write it for you, specifically addresses, okay, specifically addresses how the equity beta, yeah, how the equity beta, this is a equity beta, yeah, is affected by debt. How the equity beta, my good student, at this point, is affected by the use of debt. How is this affected by the use of debt? By the use of debt. Very important for us to recall this. So this is now where the relationship is coming in. Yeah, CAPM and aspect of Modigliani and Miller. So we can now try to link this relationship. Yeah. So therefore, for us to express our Hamada equation will always be therefore our Hamada equation. Now we will be looking at this concept. Yeah. Allow me to have it as Hamada equation. We will be talking of the beta of our equity to be beta of our equity will therefore be beta of equity. In this case, you're talking of a beta of equity. If at all, you can talk of levered, yeah, because now we are talking of the debt. We are talking of debt. You are talking of debt. So in this case, let me just so that we use a common item. So you are saying that for us to determine that, we should be having beta of the levered firm, which in this case, allow me to use beta of the levered firm, yeah, will be equal to the beta of unlevered firm, beta of unlevered firm times, of course, 1 plus into 1 minus t, we multiply by debt to equity ratio. See, so this is the model. This is the model. This is the model. Because remember, again, when you are looking at preposition, remember this is like a risk premium, right? Remember when you are looking at Modigliani and Miller preposition number 2, when you are looking at this, just recall, yeah? Recall, or let me have it here. Recall when you are looking at preposition 2. Recall preposition number 2. If you recall preposition 2, how were we looking at it? In this case, remember, we were talking of our risk premium, or to determine the value of our equity. These are what you are looking at. The value of the levered firm. We were talking of the value of unlevered plus the component of the tax shield. Talk about the component of the tax shield. Yeah. Talk about tax shield on total debt. And we went ahead and said that at this point, for us to determine the cost of equity of the levered, we'll be having cost of equity of unlevered. Yeah, we add our risk premium. And how are we achieving our risk premium, my good students? For us to achieve this risk premium, if you can recall, we were saying that our risk premium in this context would be we take our cost of equity. Yeah, we take, of course, our cost of equity of unlevered, we less our cost of debt into debt of equity ratio 1 minus T. See, these are what you are looking at. So you can see that at this point, whatever that we've borrowed is this concept here. Yeah, again, to clearly find the relationship between these two models, we've clearly borrowed this. So that at this point, when we are talking of now Hamada, we'll be talking of the beta, because you're looking at the whole market. We're looking at systematic risk. We are looking at the whole market. We're looking at systematic risk. So once we have that, now interpreting this concept will be very, very easy. Why? Number one, I'll have to take explaining this concept. Beta, BL, this is beta, right? Talk about that is, of course, the beta of these are, of course, the levered beta, right? Or rather, the equity beta, reflecting the company's risk, including what? The financial leverage. So this is BL here. We are talking of the levered beta. These are levered beta, right? Or the equity beta, where you'll find that it reflects the company's risk, including what? Financial leverage, including financial leverage. Whereas talk about BU, in this case we're talking of the unlevered beta, unlevered beta, where in this context, my good students, you're talking about what? This is like an asset beta. Asset beta. We are talking of an asset beta, yeah. So asset beta, it reflects the company's business risk independent of its capital structure. Yeah, reflects the company's business risks independent of its capital structure. Whereas T simply represents the corporation tax rate, acknowledging that interest payments are tax deductible, reducing the effective cost of debt. Whereas the E simply stands for what? Debt to equity ratio. Debt to equity ratio, DE. Debt to equity ratio, symbolizing the financial leverage, symbolizing the company's financial leverage. So anytime we talk of Hamada model, then this must always click at the back of our mind. Mwalimu has clearly tried to basically explain this concept as simple as we can, relating it with what we are doing so that it should sink in very well. So I want us to meet in our next session whereby we are going to handle a question. This question is going to come from a past paper, which will enable us to understand more of Hamada model. To this point, guys, thank you so much, and let us meet in our next class. Bye-bye.